Hello, folks. Welcome to today's webinar, How to Cut Your Client's Capital Gains Tax Cost. We'll be getting started in just under a minute here. If you are looking to access the handouts, please make your way towards the Handouts tab in your GoToWebinar control panel. We should be getting started here, like I said, in just under a minute. Hello, folks, and welcome to today's webinar presentation, How to Cut Your Client's Capital Gains Tax Cost. This is the third webinar in this six-part series, and today we will be discussing accounting and tax considerations for opportunity zone investing. Joining us today will be Rakesh Bhargava. He's the managing partner of Mango Tree Real Estate Holdings, and he will be joined by CPAs Phillip Marra and Demetrios Yatrakis.
Thanks, Tom. This is Rakesh. Welcome, everyone. I'm delighted to have Phillip and Demetrios join us today. Phillip is National Real Estate Funds Leader for KPMG, and Demetrios is the Principal in Tax Department. So I'm going to hand over now to Phillip and Demetrios to start the presentation.
Well, real quick, Rakesh, I just wanted to go quickly over the GoToWebinar engine and also just go over CPE. So firstly, folks, just on your screen, you can see the GoToWebinar engine. The attendee control panel, you can use that orange arrow to expand and hide the panel. You could toggle through your audio options to use either telephone or speakers. And if you have any questions in the webinar, whether it be regarding any technical questions or any questions regarding the material, we encourage those. Just expand the question section, type your question, and click send, and we will be monitoring those during the course of the webinar presentation. There will be 1/2 credit for free CPE for today's webinar. You need to attend the entirety of the webinar for 30 minutes, respond to all of the polling questions, and submit the post-webinar survey following the webinar. An automated CPE will be processed after all 6 sessions take place. So that will be after the series has ended, after December 16th. So we will process the CPE after December 16th. And anything else that you need to do, we'll just need to add webinar@accountantsworld.com to your trusted email list. That way you will get the CPE credit when we complete the series. So with that, Rakesh, I will hand presentation controls over to Phillip and we will get started. So ladies and gentlemen, please welcome Phillip Marra and Dimitri.
Thank you very much. Hi, this is Phil Marra. If everything is working properly, you're about to see a cover page that says Designated Qualified Opportunity Zones. Let me also introduce my partner, Demetrios Yatrakis.
Hi, everyone.
And what we're going to try and do in the next half hour is to give you a 50,000-foot overview of what the qualified opportunity zone tax legislation is about. We'll give you some examples of structures, and we'll hopefully answer some of your questions. You're seeing right now is our legal notice to say that this is general information. You should obviously do your own research to come to your own conclusions around qualified opportunity zones.
Gentlemen, well, we're going to get ready to just start the first poll question here. It'll be kind of a good preamble to what we're going to be talking about in the presentation. All right, so I'm just going to quickly launch that for everybody. And once again, poll questions are required to receive CPE credit. So what aspects of opportunity zones are you hoping to learn about today? So if you could select all that apply to you, would it be tax benefits, investment deadlines, IRS requirements, creating a QOF, or something else? Once again, answering the poll questions is required for the CPE credit. Alrighty, we have about 80% that have voted. We're just going to be another 5 to 10 seconds here. Alrighty, going once, going twice. All right, and let's close and let's share those results with everybody. So 78% of people responded saying tax benefits, 39% said investment deadlines, 52% said IRS requirements, 37% said creating a QOF, and 7% said something else. So I'm sure we're going to be very excited to talk about those tax benefits, gentlemen. All right, Phil and Dimitri, fire away.
Excellent, thank you. Well, what I'm going to start with is just the 50,000-foot overview of the Qualified Opportunity Zone legislation. As you may be aware, this was a new program that was set up as a result of the Tax Cut and Jobs Act about 2 years ago to encourage social advancement and private investment in low income communities and businesses. The goal was absolutely to get taxable investors to sell appreciate assets and reinvest those capital gains into this Qualified Opportunity Zone fund. And a fund is a misnomer. This could be a single investor in a single asset. Often in the real estate business, we think about funds as multi-investor, multi-assets. That is not necessarily a requirement, but it does need to be a tax-recognized entity. So you do need to have two partners and invest in something underneath it. This was originally conceived by a combination of our Republicans and Democrats, but it was designed to have the governors of each state and provinces that the U.S. controls to select 25% of the low-income census tracts where they thought real estate investment and business investment could incur in the near term. It wasn't designed to pick the worst of those census tracts, those low-income areas, but the ones that had the ability to be invested in the near term. Many of the programs that government sets up typically are they try to use incentives around debt and tax credits. Well, this one's a little bit different. It's really focused on getting equity invested into these areas. The good news, there isn't a lot of red tape. These are going to be self-certified Qualified Opportunity Zone funds. You're going to be able to do that on Form 8996. And the way the program works is you're going to be able to roll over capital gains from nearly any source. So you can sell a piece of real estate, you could sell a business, you could sell art. As long as it creates a capital gain, you can take that capital gain and roll it into a fund within 180 days. Again, that fund can be virtually any type of taxable vehicle. You're going to make that designation on Form 8949. And then within 6 months, that fund must invest either in a business or property. And I think one of the things that came out in the second set of regulations that helps the real estate business, they created an additional safe harbor where if you take that cash and invest it in a business and you have a plan to develop a property, but it's going to take you some time to do that, like getting zoning, like getting the construction contract in place, they're going to give you 31 months to invest that working capital into a business. Real estate is somewhat of a unique animal, and they wanted to make sure that people actually created jobs and created investment. So what they said is if you have an existing operating property, the goal was that you must substantially improve that property to make it better within 30 months. And the term that they're used here is whether or not something is original use or not. Piece of land, by definition, is always original use. The second set of regs allowed for a vacant property that has been vacant for more than 5 years to also be viewed as original use. And the reason why original use is important, if you have a piece of property that's original use, you don't have a minimum requirement to substantially improve, but you do need to improve it and get it back and create jobs. If you buy an operating piece of property that has both land and building, you must substantially improve that parcel based on the amount of the fair market value of the building when you acquired it. So, for example, if you had spent $100,000 to buy a piece of land and building and the land value was 40, you must substantially improve it by spending an additional $60,000 on the building. That was one of the idiosyncrasies related to real estate because they wanted to make sure that you made investments. Generally, qualified opportunity zone funds must have 90% of their assets in a QOF area, QOF property. And we're going to take you through in a few minutes. Dimitri will take you through the business aspects, but that's kind of the 50,000-foot view.
So, Philip, I have two questions. And by the way, first time I heard you make this presentation with these 8 bullet points, I was blown away by it because there was so much ambiguity at the time when I heard you about almost a year ago. This brought a picture perfect in just one slide. So I truly commend you for doing that again today. So 2 questions. Number 1 is that in terms of 31 months, if I'm borrowing money from a bank or from a fund or any kind of lending institution, do I have to invest both equity and the loan? That's first question. And second, can roll over capital gain from the sale of my house be eligible for this?
Okay, so let's start with the first one. The program is all designed for what's going to be the qualified funds. So in your first example, it's only the equity that must be invested into the program within 31 months because that's going to get you the tax benefits. But clearly, if you do leverage, it would be you would probably be investing that leverage as well because it wouldn't be prudent for you to borrow money and then have it sit accruing interest before you've invested it. But generally speaking, it is the equity that needs to be invested. On your second question, if your home would have to be investment property to qualify for capital gains. If a residential property, Dimitri, what would you say with a residential property?
Well, no, so residential property, right? When I sell my home, it's a capital gain.
It's a capital gain. So you can take
that capital gain and invest it into the zone. One other thing about capital gains that's important to note: it's all capital gains, so short-term and long-term, both can be invested in the zone, and short-term's taxed at a higher rate, so that's a huge advantage.
Absolutely, absolutely. Why don't we flip to the next slide, which really starts to talk about the benefits, and we have characterized the benefits into 3 large categories, and we call them DRE. The deferral benefit, which is really time value of money, the reduction benefit, which is this basis step up, and the exclusion benefit, which is the appreciation exclusion. So let me take you through exactly what I mean by DRE. When you take your rollover dollars and invest it in a fund, you are not going to have to pay the capital gains tax on that rollover money until December 31, 2026. So if you were to make an investment before December 31, 2019, you would get the time value of money benefit for 7 years before that tax would be due at the tax rate in effect at 2026. The second, and there's a 2-hurdle test here, if you're able to invest for at least 5 years before 2026, IRS is going to give you a 10% basis step up in the investment. So if you had a $100 rollover gain, you're going to be able to get a 10% basis step up on that $100. If you're able to get it in for a full 7 years, they'll give you a 5% more, which means that you would have to invest before December 31, 2019 to make 7 years. I can tell you this is the area where people make the most mistakes because they think the program ends if they don't get money into a QOZ by December 31, 2019. They're just going to lose that 5% of the R benefit. But you can continue to invest all the way to 21 and get a 10% step up, and beyond that to 2026, where you can still get the exclusion benefit. And in my opinion, the exclusion benefit is the most important, and we'll show you that in a second. The exclusion benefit, that is about if you invest $100 in a QOF, you keep that investment in a property or a business for at least 10 years, and then after 10 years or before 2027, when the program supposedly sunsets, you sell it. Any appreciation on that $100 investment is completely tax exempt from a federal perspective. And we're going to go through an example of that in a second. Secondly, the other benefit here is that many states have conformed to the same federal benefits that we've just talked about. So here, if you're in New York State, you will get all of the same federal benefits at the state level. One of the states that doesn't conform, if you're on the West Coast, California currently is not a state that conforms. In addition, many state and local municipalities are creating and allowing their existing tax benefit programs, whether it be low-income housing tax credits, new markets credits, Empire Zone credits. All of those kinds of things can be mirrored onto this as incremental for the investor. So by taking and being part of the QOZ program, you are not limiting any other state or federal benefit that may be available to you. So that's really, really valuable, in my opinion. So what I wanted to do is go through an example, because I think this really makes it abundantly clear. So let's start. In 2006, an individual investor who's a taxable investor invests $10 million in company A. In 2019, that individual sells his interest in company A for $110 million. Therefore, it had a $100 million gain on that investment. He's a good investor, this guy or lady. That's going to be our rollover gain. He then invests that rollover gain of 100 into a qualified opportunity zone fund X, and then QOFX invests in a property. If that investor is able to keep that investment in QOFX to 2026, he's going to get that 7-year benefit, which basically gives him the 15% basis step up. And you'll see that that's in the purple. The upper blue is really the time value of money, but ultimately he will need to pay tax on the $100 million gain, but he doesn't pay it until 2026. Therefore, the time value of money using an assumed interest rate here of 7% gave him a $6 million benefit. In the second example, he's going to get both federal and state benefits because he happens to be doing this transaction in New York. But the real home run is that that investor stays with that investment all the way through 2026 and ultimately sells it for $220 million, has a $120 million gain, and he pays no federal and no state tax on that. And as you can see, that is a very, very significant benefit. So the total tax benefits that he gets from time value of money, federal and state, is $43.9 million on a QOF transaction. Pretty significant.
Yeah, Phil, thank you so much. And this illustration brings the point home, as you stated, that the exclusion benefit is one of the most significant benefit. Now, I have two quick questions. If you're selling assets at different times, what would happen, number one? And number two, after the gain is invested, does it retain its character of short versus long, or it all disappears?
Okay, so let's talk about if you have interim sales. The program does allow you to have interim sales, but if you sell something, you then need to reinvest that proceeds back into another QOF related business or property. But the gain that was generated on that interim sale actually is taxed at just like any other gain that comes out. So how I always look at this is that the QOF program really is got a lot of effort at the initial date where you're making the contribution and then the exit date. Everything that happens in the middle, if you generate operating income, it would be taxed just like operating income of any other vehicle. If you sell something in the middle, you're going to be taxed on that gain in the middle. But you must keep that money invested, the original contributions that you made invested. So you've got to keep that program going for the full 10 years.
No, great, Phil. Thanks for clarifying. Now, that $100 million in your example in 2006 that the gentleman or the lady sold in 2019 was sold in 3 different installments in first 3 quarters of 2019. How would that be treated?
Again, if they're making that investment after that transaction, you can aggregate the investment. So there's no matching. Funds are fungible, so you're able to take those 3 transactions, aggregate them, and use that capital to invest in QOF.
All right, this is terrific stuff, guys.
No, thank you.
Hey,
when
Rakesh,
does the 180 days start?
Within 180 days time, of course.
So for each quarter, there would be a separate 180 days. That's all I wanted to know.
Yeah, the only differentiation there is if you're getting that allocation from a K1, you actually have 180 days from when that tax year is of the underlying partnership or LLC. So if you've got a calendar year partnership, you actually get an allocation of income and you have 180 days from December 31. If you trigger a sale of a security, it's 180 days from the sale of that security. That's the differentiation.
So in a sense, if you're invested through a partnership, you have 2 bites of the apple. You have 180 days if you could have the information and know what your capital gain is from the date of the sale within the partnership, or 180 days after the partnership's year ends. And interestingly enough, the partnership itself can invest in the QF and elect, or it can flow it through and the partner can elect.
Right. You can do it. If the partnership doesn't elect, the partner then has the right to have it. Right. What I'm going to do next is turn it over to Dimitri to kind of walk through again the timeline here, because when I go to cocktail parties and people think they understand the QF program, most of the time the challenges are around the timeline.
All right, Phil, if I could just interject real quick before Dimitri starts. First off, this is really interesting stuff. I just wanted to get our second of our 2 poll questions in here, and I think it will help in Dimitri's explanation going forward. So I'm going to quickly launch that. And it's a simple one. Are you currently an investor or developer in qualified opportunity funds? So just select one of the following: yes, not yet, but you're considering it, or no, we are not. So I just wanted to get these responses in here soon. All right. We have about 77% of people who have voted thus far. We're going to just have this live for just another 10 seconds. All righty. And just another 5 seconds here. Get everybody voted. All right, going once, going twice, 3 times, and we'll close the question. And let's share the results quickly here. So, are you currently an investor or developer in qualified opportunity funds? So only 9% of people said yes. 44% of people said not yet, but they are considering it. And 47% of people say no. So I guess my question for you gentlemen is, do you kind of see that, does that sort of tailor with your results, your feeling on the audiences that you guys speak to about qualified opportunity funds?
There's been a lot of hype in the marketplace around QOZ funds. So we have a fair number of folks that have moved forward on single asset transactions. Fewer have moved on is relating to multi-asset funds. But we have a number of clients, I would say greater than a 9% share. And some of it is aggregating the capital. We're still educating many of the family offices and registered investment advisors who happen to provide tax advice to wealthy individuals. We do expect that this program will continue to grow and get bigger, but our numbers are a little bit higher than the numbers that we've seen here.
Yeah, I would agree with that, and I would add that, for multi-asset funds that have gone on and raised the cash, they have to deploy, right? There's a timeline for deployment. So they're already out there buying assets, and many of them are on their second or third deal.
Yeah. The number one thing to recognize here is that this is not like the tax shelter days of the 80s. These deals must make economic sense. All of the tax benefits inure, in my example, the E benefit is all about appreciation. So if this is not a good real estate deal, the QOZ structure doesn't make a bad real estate deal work. It makes a good real estate deal just better. Dimitri, why don't you get into the timeline?
Yeah, sure. So for purposes of the timeline, I'm just going to assume that there's a capital gain triggered by a partnership in 2019, and the partnership itself is going to elect to be invested in a QF. So that partnership, after the recognition date of that capital gain, has 180 days to fund the QF. So assuming that funding happens in 2019, your first milestone date is 2024. That's the 5th year anniversary of the investment in the QF. And at that point, that partnership would get a 10% basis step up in its QF interest. The next significant date is in 2026. That would be the 7th anniversary. There would be another 5% basis step up, and Phil talked about sort of the benefit of these step ups, because these are actually eliminating some of your gain on the previous transaction. However, at the end of the year in 2026, on 12/31/2026, any remaining deferred gain must be recognized. So if you rolled $100 of capital gain into the QOF or the QOF, by 2026, you've had 15% of that gain eliminated. And on 12/31/2026, you're picking up $85 of capital gain, assuming a $100 investment. If the QOF holds on to that investment past 2029, that's the big 10-year date. So a sale after 2029, there's a step up to 100% value. So basis equals value, and there's no federal tax triggered, and in most cases, state and local tax. And Phil alluded to it, there are two significant dates for getting maximum benefit from the program. Capital gains have to be invested in the QOF by 2019 to get the full 15%. If you invest in 2021 in the QOF, then you'll only be getting the benefit of the 10% basis step up. The next date is 2021. 2021, you have to invest, and if you miss that date, then the basis step up goes away and you get 0 basis step up. But you still get the deferral till 2026.
Right. The key is that you can new investments into a qualified opportunity zone fund can occur all the way to 2026, and you'll only get the exclusion benefit after 2021.
Right.
Okay, so just moving on to the next slide.
Demetrios, one more thing that you it's in your slide that you got to exit before 2047. That's correct, right?
Well, it's unclear whether that needs to be an exit or not. But by 2027, the IRS is going to say that you have to, sorry, 2047, you're going to have to pick up that deferred gain, that gain on the 10-year step up. It's unclear whether they'll force you to sell. I think they're assuming you'll have sold by then and eliminated your 10-year gain. But it should be answered in the final regs as to what happens in 2047. Okay, so just moving on to this structure. So we just wanted to give you guys an idea of the structure we're seeing. We're seeing a 2-tier structure, and this is being driven by the fact that for the QOF, cash is not a good asset. And so the way that the IRS dealt with this, they created a working capital safe harbor to allow you at the QOZB level, so that's a lower tier partnership or corp, but generally for real estate, we're going to say it's a partnership. At that level, if you have a working capital plan, and it's a written plan that states how you're going to spend your money to buy the property or substantially improve the property, if it's written, there's a schedule, and you substantially comply with it, you have 31 months to develop your property. So what we're seeing is this 2-tier structure where rollover dollars go into the QOF. The QOF, usually within 6 months, because that's when the first testing date is, will fund the QOZB. The QOZB will enter into a working capital plan saying, you know, we plan on developing or buying this building and developing it within 31 months. And that's the way we're managing the cash issue. Because we have the 2-tier structure, it's important because there's really 2 tests, right? 90% of a QOF's assets have to be in a zone, but once you form the lower tier QOZB, that QOZB has to qualify as a good QOZB to be good qualified property when you're testing at the QOF level. At the QOZB level, there's a few requirements. 70% of your tangible property has to be in the QOZ, so you can have up to 30% of that property outside of the zone. There is an active trader business test. 50% of the gross income has to be from an active trader business. There's a safe harbor here. So the safe harbor looks to whether 50% of your hours by employees or independent contractors are performed in the zone, or 50% of the amounts paid to those people is in the zone. And then there's a more subjective test that looks to whether 50% of your gross income is related to the tangible property and management or operation functions happening in the zone. There's an intangible property test. So 40% of your intangible property has to be used in your trade or business in the QOZ. The QOZB cannot hold more than 5% of its property in non-qualified financial property. So you can't have another partnership below that, because that would be financial property for purposes of the test.
And they also don't want you to run a hedge fund in the QOZ. They don't want to give that benefit out to those folks.
Right. So you can't have the QOZB originating loans and doing things of that nature. And then your business down at the QOZB level cannot be a sin business, which is defined as a massage parlor, gambling facility, liquor store, hot tub facility. Interesting, a golf course. I guess they were thinking of our president.
Demetrios, I have a question on your first bullet, 70% of tangible property. I'm sorry. Is that applied just to business or also to real estate? Say I have 100 single family homes, all identical, same price. Can I put 70 in the low income census tract and 30 in a regular zone? Is that allowed?
That's right. So it just looks at tangible property, and you can. It's one of the ways that if you have enough tangible property in the zone, you can invest outside of the zone and get some of the benefits. And in terms of whether it's really for businesses too. So when we talk about internet startups in the zone, the barrier to entry is very low because their tangible property is, some computers and desks. So, this program is good for real estate investment, but also for internet startups and other businesses.
No minimum, no maximum. So it gives you lots of flexibility.
Okay, so moving on. The long anticipated second regulations did clarify some things we were getting questions on. Probably the number one question I got before the second set of regs was whether you could do a debt finance distribution, or whether that debt finance distribution would trigger your deferred gain. And so we're told that under the second set of regs that debt finance distributions are allowed. So that's a great way in 2026 for investors to pay off their 2026 deferred tax. Phil alluded to it. If a property has been vacant for 5 years, that property can now qualify as original use property. It's a great way if you have dilapidated buildings in a neighborhood. It really can serve to revitalize them. The working capital safe harbor, which we talked about in the structuring piece, really a way to extend your timeline for deployment to 31 months. We can do multi-asset partnerships now. Before we got the second set of regs, the only exit that we felt comfortable with was the sale of the QOF interest. Now, if the QOF sells its interest in the QOZB, that gain gets passed through the investor, and there's an exclusion at the investor level. So that was a big deal, because before that rule, we were going out, and the structure really was these contractual funds, but now we can actually do something that looks like a more traditional fund. Asset recycling, again, Phil alluded to this. If the QOF sells its investment, but invests those dollars into another zone within 12 months, the QOF 10-year timeline keeps ticking. The investors will have to pick up that first gain, but when they sell the second property, they should be able to get the 10-year exclusion. And then the last thing that was really a big deal is really the idea that you can syndicate your QOF interest. So if you form a QOF and an investor sells that eligible QOF interest to another investor who uses rollover dollars, that new investor can get the benefit of the QOF.
Yeah, the one thing there, though, is the 10-year rule for holding. That secondary purchase starts a new 10-year clock. So if somebody made an investment in 2019 and then sold it and had a secondary purchase in 2021, the second investor has to hold from 10 years from 2021. So that's just one thing to be careful of. Now, we covered a lot in about 35 minutes. We kept you here a little bit longer than planned, but you can see there's a lot of different things here that have to be understood before you exercise an investment in a qualified opportunity zone. But the tax benefits that are available are very, very significant to taxable investors.
And so Phillip and Demetrios, thank you so much. The contact detail for Phillip and Demetrios is on your screen right now. please make a note of it. Sharon, thank you so much. And Tom, thank you so much for helping us put this all together. It's a great session. And Philip and Demetrios, every time I hear you, I learn something new. So thanks so much, and keep creating an impact in Opportunity Zone community.
All right. Thank you so much. Thank you so much, Rakesh. And Philip and Demetrios, thank you so much. Again, your presentation was chock full of information, and we were really interested in everything that you guys had to say. I'm going to take back presentation controls here, and want to thank every attendee for joining us today. Our next webinar in the Opportunity Zone series, it'll be part 4 in the 6-part series. It will be on November 18th, and it will focus on estate planning issues and strategies in Opportunity Zone investing. It'll be with Rakesh, who you just heard, and with attorney Matthew E. Rappaport. So that will be on November 18th. Once again, folks, thank you very much for joining us today, and we hope to see you in the next part of the series. Thanks so much.